And so today we're going to be talking about the cash fraud and internal controls. And so yesterday, the last few lectures, we talked about inventory, and now we're going down the balance sheet, or up in this case, and talking about cash. And so cash is what we're really going to be focused about is protecting cash. So when we talk about internal controls, there's a lot of detail around internal controls, and one day you're going to take a class if you stay in accounting on auditing and internal controls. But we're going to go over that concept high level and how we protect cash and how we build systems to protect assets. And then we're going to define cash and cash equivalents and explain how to record and reconcile them. We're also going to talk about ratios. Like I've said in every class, we're going to learn how to calculate day sales uncollected ratios. And then we're going to talk about how we can apply internal controls for cash and reconciliations of bank reconciliations. So what are internal controls? Well, internal controls are policies and procedures that protect assets, ensure reliable accounting, and uphold company policies and promote efficient operations. What does that mean? It's quite literally controls for our company that make sure that we're protecting our assets. So for example, how many people here have worked either in the restaurant industry or have worked for a retailer? You can just like raise your hands or give me a thumbs up if you've done it. So if you ever worked a cash register in that situation, you generally have to, at the end of your cash registers, you have to, so many of us have done this, right? At the end of the day, you have to make sure that your cash matches what's on your sales receipt. And then you reconcile that and you have a manager check it. That's a control the business has implemented to make sure that you can't pocket some of the cash. Controls also might be the fact that you have to enter in a sale into a system and there's a barcode, right? If you really take a step back, you don't really, no company has to do those things. They do those things in order to protect their assets, right? You could just have someone sell and try to trust them that they're doing it all correctly. So all companies are very methodical and try to think through all of these internal control systems in order to protect their assets and make sure that they're reliably accounting for information. This has actually really gotten a lot more attention since the Sarbanes-Oxley Act of 2002. And so the Sarbanes-Oxley Act requires managers and auditors of public companies to certify that the internal controls are working for a company. And so before 2002, auditors didn't have to give an opinion and companies didn't have to give an opinion on if their internal controls were working. But then there was this huge bubble that burst from Enron and many other companies like WorldCom. And it's going to be very interesting. You'll hear about it a lot, where they committed massive amounts of fraud and ultimately led investors to like people jumping off buildings because they lost so much money and employees losing their entire life savings. It was very sad. And the government's released the Sarbanes-Oxley Act saying, in order to protect this from happening in the future, we need to enhance our reporting and protect investors. So now auditors and managers have to sign off that their internal controls would capture any issues like this going forward. And so you can get a whole job. There's tons of jobs on just being an internal controls expert, where you go in and assess a business and see where the risks of fraud are or where inaccurate financial reporting, and then protect that business, build controls around it. So what are the principles of internal controls? And principles of internal controls are common to all companies. We need to make sure that each person has a responsibility and they're established, that we have records of all of the transactions, that anything that has a risk, we have some way to mitigate that risk, which includes insurance or even insurance or bonds for key employees. Like if an employee quits, we might have a way to mitigate them from either quitting or getting insurance if they quit or die. Making sure that those who hold assets are separate from the record keepers, so the person who's holding the asset can't fudge the records. Making sure that there's divided responsibility between transactions, and that we use technology in a strong way and regularly have independent reviews of materials. And so you can imagine this becomes rather expensive to maintain, but it's very useful because a lot of costs come from theft, right? Theft or fraudulent misrepresentation, which we'll be talking about the fraud triangle in a second. And so the idea here is we can really use technology to limit fraud in a lot of ways, where you might have heard of Bitcoin, right? Or these cryptocurrencies. That's kind of what's so attractive about them, is the fact that any kind of transaction would be able to be live audited. You'd be able to see where the money is going and how it's being used in the cryptocurrency's code. And so there's a lot of thought around how that would make fraud impossible, because you'd see everywhere the money went, right? While we could use cash, or we could fraudulently misrepresent records currently using accounting systems. And so the idea is the more we systemize these records, the easier it would be not to commit fraud. Like for example, who here has like the Starbucks app, right? Or any other food apps? Now you might think, wow, the companies must be doing a great service to us because we can order with the app, right? Like that's really nice. And they give us free stuff, like every 10 drinks you get another drink free or something like that. It has nothing, sure, that's a nice perk, but the reason they're doing that is because it limits theft, and it's an internal control for them. They know if you order on your phone through credit card, there's no way an employee can steal money or fudge the numbers. While if you go into a store and buy a coffee, the employee might just give you a coffee and pocket the cash, right? There's not a strong control against someone doing that. And so their companies are incentivized to try to get you to use their technology because it ensures that they will receive the money. And so that's where technology, fraud, and internal controls are important, right? It reduces these processing errors, limited evidences of processing, and increases the e-commerce. And then it helps the separation of duties concept, where the person who's selling you the thing isn't also collecting the cash. When I used to work in bars, it was very common for a bartender to pour a drink for someone and then pocket the cash, right? It's very easy for a bartender to do that. It's a lot harder if it's on an app, which is also why there's some of these bars now where you can go in, and if you put your credit card on file, you pour yourself drinks. Think, oh, wow, they're smart. They're saving the bartender. No, they just don't want people stealing, right? So theft is a real issue. And we'll be talking, there's something called a fraud triangle, which we don't have a slide in here, but I'll pull it up over here. This is really what we're trying to prevent, is this fraud triangle. So there's always three opportunities for fraud. There are three things that would cause a fraud, or three things that exist, and only one of them needs to be violated in order for a fraud to occur. So there's opportunity, motive, and rationalization. And so you can ask yourself, does someone have motive to create fraud? Fraud being like, hey, fraud can be something as easy as stealing cash, or something as complex as fraudulently changing numbers in order to get a higher bonus for an executive, right? Fraud can cover any of these. Fraud means intentional misrepresentation in order to have a personal gain, right? That's what fraud is, fraudulent misrepresentation. You'll learn more about it in business law. But the whole key of fraud is someone intentionally lies or misrepresents information in order to have some kind of gain, right? And so there's always these three components. You have opportunity, rationalization, and motive. Rationalization can be something like, I haven't received a raise. Like, hey, minimum wage hasn't gone up in 10 years. I can't feed my family enough, or hey, I deserve a break. I'm going to pocket this extra $5. That's rationalization, right? Almost anyone can rationalize, right? It could be that something as simple as a minimum wage thing, or it could be, hey, my boss makes twice as much as me. I don't care that I make $200,000 a year. My boss makes twice as much. I should get a payout, right? There's rationalization. Motive, personal financial pressure or addiction. So if we hire someone and we see that they have addiction in their past, or if we know that they have a family of 12 kids, or that we know that they have a brand new car and a brand new house that they borrowed money on, they might have pressure to commit fraud, right? But it could be as simple as it could be something either extreme, right? It could be greed, or it could just be out of financial necessity. And then there's opportunity. That can they actually do it? Is there a flaw in our system that allows them to steal money or fraudulently misrepresent information? What is important from this fraud triangle is we can't control one or two, right? Everyone's different. Everyone has their own motives. everyone can rationalize information, rationalize a kind of reason to do something wrong. All we can control is the opportunity. And that's where internal controls are focused on, is this opportunity, mitigating that risk. So there's some limitations of internal controls, like human error. There's always an issue. Like, people are tired and they make mistakes. That's why we try to use systems for a lot of it. Human fraud, where humans intend to try to get over and try to conquer the system, especially those that once you know systems, you know your way around them. We talked about the human fraud triple threat, the fraud triangle: opportunity, pressure, and rationalization. Well, all we can control is opportunity. And then the key issue here with everything in accounting is that our costs of the internal controls can't exceed their benefits. Like for a McDonald's, I can't have a manager check every single person's transactions because it'd be too expensive. So we have to take some kind of risk and find a way to make it cheap. So the kind of questions I can ask you around internal controls are something like this. Identify the following phrase terms and link them with the purpose of the internal control system, the principles or limitations of internal controls. And so protect assets would be purpose of internal controls. I'm not going to ask a question like this, honestly. I think you could just skip this. I'll ask you more of like I just want you to understand the total concept of internal controls. I wouldn't worry about this need to know solution here. I think it overly complicates the situation. Just make sure you understand that these are the limitations and these are the principles, and understand the whole goal is really to protect assets here. Protect assets, ensure reliable accounting, and uphold company policies. I think this question is kind of pointless and confusing, so I wouldn't dig into it. We'll go over the midterm, how I'd want you to look at the question. But really, I just want you to understand the principle of internal controls and what the goals are, and also understand the fraud triangle.